So we've got half an hour to cover the golden era of private credit just before you want to go off and have some lunch. So we have prepared this panel, so it's going to be pithy, it's going to be to the point. As Rachel said, 1.6 trillion US dollars in private credit assets. Prequin has predicted that by 2028 that could grow to 2.8 trillion. And in their first half piece of research that went out at the beginning of the year, they remarked that investors are optimistic about private credit and they want more. Now, I'm sure Nikos will have an opinion about this. So we've got quite a lot to unpack. I'm going to start by asking Nikos and then the rest of the panel to introduce themselves.
Thank you, Fiona. First of all, thank you for the invitation to be here. Raha, amazingly organized event. Thank you. I work for a small but highly effective investment team in Geneva, managing the assets of a single family. The family has origins back in the 40s and starting with 1949 in commercial shipping. That's it. Thank you.
Miguel Fidalgo, I'm a managing director with Signal Capital Partners. We are a London-based special situations private credit fund. Been around for about 8 years and do a lot across the private credit and some public credit spectrum.
My name is Suzana Perić. I run the origination and sourcing at Oaktree Capital Management for Europe. Our platform offers capital solutions, private capital solutions up and down the capital structure.
Hi, I'm Leander Christofides. I'm the Co-CIO of the JP Morgan Global Special Situations team. We operate at both distressed, stressed, and performing credit funds.
Thanks, everyone. So let's start off by having a look at the title of this panel and understanding why it is the golden era of private credit. So I'm going to start off with you, Miguel. How has this asset class really benefited your clients?
I think the primary reason that private credit has grown in the last few years is the well-publicized replacement of banks for a variety of regulatory and other reasons, replacing banks as the right source of credit capital in all sorts of circumstances, such as sponsor-led deals and so on. A less publicized reason that I do believe is worth highlighting is that, in a sense, private credit has taken what used to be called mezzanine and PIK and some of these sort of more creative types of funding and made it a much broader, much more comprehensive, much more tailored, deeper market to access tailored capital. So whereas before you may have had the lenders, the equity, and perhaps some sort of simple mezz structure, we now find that funds like ourselves can put in place a combination of cash pay, PIK, some option structure, some contingent participation, maybe other creative terms that allow our investors to get the return that they want, but also for the terms of this capital to meet the needs of the borrower. And that type of creative, tailored financing that is possible in private markets is now being done with a level of breadth and sophistication that I personally didn't see a decade ago. And I think that's a big contribution from the private credit market.
So it's the flexibility and the customized solutions that you can offer to your clients. Suzana?
Yeah, I think, you know, the appeal is probably it's on private credit, it's an all-weather floating rate, resilient through the cycle product, which produces attractive returns. In terms of value creation, I think private credit stands out because of, you know, its sort of bespoke and unique origination, flexibility, as Miguel mentioned, and scale. So the size that you can print for borrowers is quite impressive.
And Nikos, you're going to be the recipient of all these solutions. What's your view and your experience of private credit? How does it, if you're comfortable talking about it, fit into your portfolio of investments at the moment?
First and foremost, this is not a new thing. Yes, I mean, private credit or loans have existed for some time outside of the banking world. But as Miguel correctly said, it's replacing banks now due to regulations. So we have had experience throughout the cycles with that. It makes sense to have such an exposure. Distributions are more regular. You can count on it. If you are with the right GP, then you feel a bit in safer hands. But something to get out of our circle a bit. This is great for the economy as well. Let's assume that this didn't exist. With the banks, being cornered by the regulations, the economy would have suffered much more. So it's great that you have the lending platforms to do that.
Thank you. So I want to move on. I think the arguments for private credit those arguments are fairly well-trodden paths. It's always interesting digging deeper into those, but let's have a considered view. Are there any concerns around the industry? I mean, defaults are obviously something that everyone should be concerned about. And I'd like to direct this at you, Nikos, because as an investor, this is something you're going to be looking at. But how do you see these being handled by fund managers? What's your concern when you think about investing in this sector? How are people looking at defaults?
You're correct. There are many risks to think about, and that's the biggest part of my job, in a sense, to find first of all, to find where do we want to invest within the private credit. Is it venture debt, direct lending? Is it special situations? It's a huge universe. We're talking with two words. You describe a whole huge universe. And we have good representation of this universe here. With defaults, again, the word default can mean different things to different people. You can see private credit in general. If you look at the industry numbers, they say defaults are very low. That doesn't mean anything to me. You need to look through it. It's just, you move from the banks to the private credit world. It doesn't mean that suddenly you don't have defaults in the loans. They're the same loans, the same industry. So we need to understand, I need to understand better, how will the fund manager go through the process of the amendments. What does it mean if they have to spend a lot of time on that? What kind of research they would do beforehand, what kind of team they will have in place if the amendments or if defaults come. So it's very important.
And when you speak to managers, do you think that this is something you obviously focus on? And different managers will look at defaults in different ways, or how they handle the workouts. Is that right?
It's how they handle workouts that it's important. Yes.
Yeah. Suzana, can you talk more about that from your perspective?
Yeah, I think every manager, is set up differently and deals different with these maybe more challenging situations. Some have, proper workout portfolio teams. Other asset managers have the same person, covering the deal throughout the lifetime, even when things get a little bit tougher. So, everybody has a different way in terms of setup. But what I would say is that looking at sort of what we are seeing at the moment is that it's not so much, I think, an issue of fundamentals. It's more sort of, interest cover driven, obviously, with the higher interest rates, where we see potentially more trouble on the horizon overall in the market. But I think the private credit market is well set up to deal with these. And a lot of times now, just speaking about corporate direct lending and specifically sponsor-backed direct lending, oftentimes you will have a sophisticated sponsor you're working with who has a substantiate equity amount. So there's a big equity cushion in front of you, and is most of the times willing to follow the money and continue supporting his portfolio company.
Leander.
Yeah, I think the way to answer this question is, first of all, the explosion in private credit has been linked to the explosion in private equity. So a lot of private credit managers, the sourcing of their transactions come from good relationships with sponsors. Those sponsors give them their transactions. They know how they want them structured, and there's a sort of symbiotic relationship. So when a deal goes bad, does that private credit manager actually have, even if he has a loan agreement, can he actually even enforce on it from a relationship perspective is actually a big question. Hasn't that kind of, is he really going to bite the hand that feeds him from that perspective? And I think secondly, the truth is a lot of what happens in private credit, a lot of that world is hidden. So for example, when we think about public market defaults, the definition of default is, a missed coupon with a bond, a missed maturity, but also distressed exchanges in the bond market count and default statistics. If you look at the private credit market, there's this exponential growth in amend and extends that happened over the last 6 to 9 months. And if you use that as a proxy for stress in the loan market, it's like there's an implied default rate in the loan market, which is now sort of running at sort of 7. If it was compared like for like with the bond market, it's like there's an implied default rate of about 7% in the private debt market that's hidden through these amend and extend. So I think what's happening with defaults or implied commercially like a default is that it's being hidden and people are trying to get through the next 12 to 18 months because they're not really set up to deal with the size of the teams versus the capital they run or the number of problem credits they have, or from a relationship perspective. So there's definitely some problems building that are being hidden underneath the carpet, and we're going to see that really manifest itself over the next 12 months to 18 months. Interesting. Miguel, do you want to add to any of that?
I would just add 2 things. So first, Jamie Dimon of JP Morgan recently made the comment that he thought that regulators are going to spend more time looking at private credit. Part of what has supported this growth is that it's a relatively unregulated industry, which promotes growth, but has potential trade-offs. When a market quintuples in size over a few years, inevitably there's going to be some excess in there. And then I would add, if you will, a prediction, which is I would expect some sort of a headline-making blow-up to A, be likely, and B, drive that regulatory review. So some large private credit situation will, anybody here is familiar with what happened with Greensill, but something that will ideally have a low person being impacted effect, but even missing that, some sort of a very front page of the FT friendly story with a private credit background would drive some of that regulatory change that will then in turn maybe make it a little harder to just amend and extend indefinitely.
And we are seeing regulation coming out, PFAR regulation that is going to, if it goes through, impact private credit funds. When we were doing this panel, another thing that both Suzana and Miguel mentioned as a potential hiccup, something to be concerned about, is whether risk is being correctly priced in the deals that you're seeing. So, Miguel, if you can continue on that one.
When a lot of capital chases a limited opportunity set, it is rarely the case that risk is priced attractively, because there's plenty of reasons for somebody to just say, a client is giving me money, I'll just keep investing it. And there's years ago, the then CEO of Citigroup, Chuck Prince, had this quote about, while the music is playing, we got to keep dancing, which is some version of, it's not my problem for now, and I got to keep doing what we do. So there is an element of that in the market, and there's plenty of deals that we pass on because we feel that the risk is not being priced correctly. And so it's incumbent upon participants that want to survive and still be in business 10, 15, 20 years from now to have some discipline and let somebody else do the deals that you're concerned about. But yes, a fair amount of that.
Suzana.
Yeah, fully agree. I fully agree. And I think, the last couple of years were fairly comfortable for us on the private credit side, where we felt that risk is being priced adequately, and I think people need to be cautious, especially if you look at probably sort of the more larger part of the market where there is a lot of liquidity out there. So that's something to be mindful and certainly comes into our thesis. But there are still a lot of pockets within the private credit market where I do feel that you can, price risk properly, put in proper downside protection, have tight structures. So, and the private credit market, I think, is generally quite good in moving and shifting towards where the opportunities lie. And right now it feels that it's probably more in the mid-market space, whereas in the last 2 years, which was quite, I think, extraordinary, the role that private credit all of a sudden played in large cap deals. This is, I think, rather unusual, and we can see it now as some of the private credit deals are being refinanced through the broadly syndicated market. That is completely natural because this is where they should have been from day one, but the market was shut. So, yeah, it's something to bear in mind and think about. But as I said, we pivot to the parts on the market where we feel that we can create value.
Thank you. Leander, generally in your business or from your own perspective, where are you seeing potential risks?
So 2024 will be the biggest year of defaults on a nominal basis since Lehman, in euros, dollars, and cents. As a percentage of the market, it won't be, because syndicated loan market has grown 2.6 times since Lehman. Private credit market's up 9 times since Lehman. So, the cumulative percentage default rate is not as high as Lehman period, but in absolute dollars, euros, and cents, it'll be bigger than Lehman, which I don't think people realize. There is a lot of losses being taken right now off what is now a very large market. The other interesting point here is that the loan market today, for the first time ever, will have a higher default rate than the high-yield bond market. Because you can do adjustments to EBITDA, loans are the chosen instrument of choice to take risk by private equity sponsors. As the high-yield bond markets move to being sort of a levered corporate market, and inherently less risky. So for a lot of us in the room who have a few gray hairs, we grew up thinking that secured loans are safer than unsecured bonds. That's not true anymore. But when you think about how people go to get approved on provide capital to private credit, there's a view on what is the historical default rate. What is the view, if a loan does default, what is its recovery? And we're already seeing now that historically, it used to get to be a 65 cents recovery for a loan that did default. We're averaging about 38 cents today when a loan does default. So the historical knowledge or reasons why people enter the private credit market are perhaps used on a rear view mirror versus what is happening on a forward-looking basis. What that really means is that if you are an asset allocator, you're going to see a lot more bifurcation in performance. The market has matured, it's got bigger. It used to be that anyone involved with the loan market had a very similar sort of performance in terms of their returns for their funds. Now you're going to see a much wider dispersion of performance, who's actually got differentiated sourcing, who's got good, dealing with problems in their portfolio, all the things that you know. And that's just a fact of how the market's matured and what that will mean on an ongoing basis. But it's no longer, I like loans, it gives me good income, it should be roughly this return and this risk profile. That's a historical statement.
So to put you on the spot, if you were talking to Nikos as your client and potential investor, what would you suggest? What are the kind of questions he should be asking of you as a manager? And Nikos, I'll ask you a similar question. Thank you. See if you agree actually with what Leander says.
Well, I mentioned some of those key points now, but I think Manuel made the comment that a lot of capital is being raised in the private credit world, and we are seeing a race to the bottom happen from some of those managers where they don't have differentiated sourcing, so they are competing on price, or the price looks attractive, but the risk profile is quite high. For example, most private credit managers talk about 50% loan to value on average, but actually if you include all the adjustments, it's suddenly 70%, or maybe could be higher depending on sectors and countries. So we also talked about interest coverage here. 40% of the market is rated B- or below, and almost 2/3 of that market has interest coverage of less than 1 times. A significant proportion of the loan market today is cash flow negative. So there's a lot of hidden statistics and things that are going on. So the managers that have really differentiated deal flow will to kind of show through that. The last thing I just thought anecdotally that was really interesting, the other day I was looking at a credit, and the private credit manager had a covenant on that deal, but the covenant was pretty much close to where the equity or the purchase price. And I said to my analyst, why is the covenant so close to the equity value? And my analyst said, don't you realize? And I said, no, I'm sorry, I don't get it. He goes, so that the private credit manager can say that he has a covenant. But it's a worthless covenant, So there's the games that are played from amendment, amend and extends, covenants, hiding real leverage, cash flow, are quite extensive, and so that bifurcation is really going to drive itself through.
So Nikos, as an investor, when you look at private credit funds, are these the kind of things you're looking out for? Are these the kind of things that Leander's speaking about that concern you?
Okay, I think it's easy to understand. We need to understand what risk we are taking, whether it's a private credit or private equity or anywhere else. In specific case, we need to understand, the fund manager that we invest with, what kind of loans they're making, what kind of covenants, what happens if the rates go up, what happens if they stay higher for longer, what happens if there's a workout, how much of their workforce they can devote to that. Leander said that in terms of amounts, we're going to hit a net new high this year. Okay, who's going to deal with all these things? So it's understanding the risk, and as a consequence, as a follow-up, price it accordingly. Do we want this risk in our portfolio? Who do we want to buy it with? Who's the right person to represent us in the market?
Okay, thank you. Right, we're obviously running out of time, so I've got a one last question for each of you, and I want us to go out on a high note, because I think we have spent some time looking at what the possible bear traps could be in this asset class. So starting with Nikos, what do you think we've got to look forward to in private credit? What's going to be good for investors like yourselves?
Sorry, in terms of what are we looking
forward to? Why should someone be investing in private credit?
Very good. Just a bit of disagreement with the title. I don't agree with the golden era. That means that if it's a golden era now, it means that in 2-3 years we should take money back, or we should not have such a high.
Or maybe it'll be a platinum era.
I think it's a more long-term allocation. We should have that in our portfolio. Credit is part of the capital markets. If it's done correctly, then it will add alpha and beta to our portfolios.
Okay. Yeah. Miguel?
I think of this as the era in which private credit is becoming a slice in people's pie chart. So if you are the endowment of XYZ or the pension fund of ABC, if you were to go back 25 years, you may not have had a slice for private equity or venture capital unless you're Yale or a few thought leaders. Now everybody's going to have a slice for hedge funds, a slice for private equity, a slice for venture capital. In some cases very small, but still those are considered to be slices that you kind of need to have on your pie chart. And I think we're entering the era where private credit is a slice in your pie, and you just need to then debate to your investment committee whether it should be this size or this size, but it's an institutional asset class, and that will have all sorts of tailwinds for the industry.
Thank you, Miguel. Suzana?
Yeah, fully agree. So private credit is definitely here to stay. It's part of the toolkit these days. I'm very excited about, hopefully the M&A machine starting to regain more momentum. We're seeing more processes and more sales activity starting. And if, when people say, oh, yeah, but, there's so much money being raised for private capital or private credit, if you look at only the amount of dry powder that sits within the PEs, which is about, 2.5 trillion, and there is about 700 billion of private credit, there's a long way to go. And, I think we need to think about private credit as being part of the market. So there's not only private credit or only banks. So they coexist quite nicely next to each other, and there's enough for everyone.
Thank you. And finally, Leander.
Look, I think that private credit's got to such a size now. It's such a broad market. There's so many different parts to it that its appeal is here to stay for the long term. There are opportunistic transactions available today which have phenomenal risk-reward right now. As Suzana just said, the M&A machine is going to really, we've seen it start off again and is really sort of driving some volumes in the first half of this year as well. So it is no longer just one blob, but is actually a multitude of different sub-strategies that have enormous potential in people's portfolio.
Well, thank you very much. So the golden era of private credit, we've had 30 minutes to try and do it some justice. I think our panelists have done an excellent job. Would you please join me in saying thank you?